The largest investor outside of American territory has typically provided support during times of financial uncertainty for the Treasury. Certainly not this time. In this video, let's find out more about this problem. The top players in the $23.7 trillion U.S. Treasury market are retreating everywhere you look. The majority of those who were once lined up to purchase U.S. government debt, including Japanese pensions, life insurers, foreign governments, and U.S. commercial banks, have since backed off. The Federal Reserve, however, has increased the rate at which it intends to sell Treasuries off its balance sheet at a rate of $60 billion per month. Even though the impact would be felt, there probably wouldn't be much cause for concern if one or two of these typically reliable sources of demand left. However, they are all reversing course and raising serious concerns, particularly in light of the recent unheard-of volatility, declining liquidity, and lackluster auctions. Market observers conclude that even though Treasuries have fallen this year to their lowest level since the early 1970s, more pain may be in store until fresh, reliable sources of demand appear. Furthermore, it's terrible news for U.S. taxpayers who will ultimately pay for increased borrowing rates. In Asia, Treasuries fell once more. The 30-year U.S. bond rate increased 9 basis points to 3.94%, the highest level since 2014, and the yield on 10-year notes increased 7 basis points to 3.95%. Undoubtedly, many people have anticipated collapses in the Treasury market throughout the past 10 years, only for purchasers and central bankers to intervene and stabilize the market. In fact, the short gain in Treasuries in recent times may only be the beginning if the Fed shifts away from its aggressive policy bend, as some are betting. Analysts and investors claim that this time will be very different since the latest inflation impedes officials' ability to ease policy in the near future. Massive premium. Unsurprisingly, the most significant loss of demand is due to the Fed. In the 2 years leading up to early 2022, the central bank's debt holdings more than doubled to exceed $8 trillion. If policymakers persist with their current roll-off plans, the total, which includes mortgage-backed securities, may drop to $5.9 trillion by the middle of 2025, according to projections from the Fed. Even if most people would agree that reducing the central bank's market-distorting power is beneficial in the long run, it is a sharp turnaround for investors who have become accustomed to the Fed's disproportionate presence. Still, market anxiety would be much reduced if the Fed were the only entity to change course, given its long forecasted balance sheet reduction. But it isn't. Giant pension and life insurance organizations from Tokyo have virtually been locked out of the Treasury market due to prohibitively high hedging expenses. Even though nominal rates have increased above 4%, yields on U.S. 10-year notes have fallen well below zero for Japanese investors, who pay to have currency swings removed from their profits. It's not just Japan either. In recent months, nations worldwide have been depleting their foreign exchange reserves to defend their currencies against the rising dollar. According to International Monetary Fund figures, emerging market central banks have reduced their holdings by $300 billion this year. Therefore, demand from a group of price-insensitive investors who typically invest at least 60% of their reserves in U.S. dollars will be minimal at best. Banks bail. Over the past 10 years, others have stepped in to fill the void left by one or two significant Treasuries buyers who appeared to have backed off. According to Jay Barry, a strategist with JP Morgan Chase & Co., that is not happening this time. As the Federal Reserve's tightening of policy takes reserves out of the financial system, demand from U.S. commercial banks has diminished. According to a study by Barry last month, banks bought the least quantity of Treasuries in the second quarter since the latter 3 months of 2020. The decline in bank demand, he continued, has been astounding. Bank demand for Treasuries has decreased as deposit growth has slowed substantially, especially as the duration of their assets has increased sharply this year. Overall, Barry added, there's a pessimistic undertone for rates. However, as the Treasury's structural underpinning breaks down, others have stepped in to fill the void, albeit at higher rates. The most significant increase in second quarter Treasury holdings among investor categories monitored by the Fed was among households, a catch-all category that includes U.S. hedge funds. Since yields are at multi-decade highs and there is a possibility that Fed policy tightening may cause the U.S. to enter a recession, some people believe there are compelling reasons why private investors should find Treasuries attractive right now. However, most people believe that the environment favors higher yields and a more volatile market. While a metric of market depth recently hit the worst level since the start of the pandemic, a measure of debt market volatility rose in September to the greatest level since the global financial crisis. Market participants believe that the Fed will continue to raise rates unless something breaks. The Treasury market is what that something increasingly appears to be, which would be the worst-case scenario on anyone's ledger. The Fed has a limited amount of time to act. The Fed and other central banks have been suppressing volatility for years, but now, according to experts, they're the ones who are actually causing it. That concludes today's video. Thanks for joining us till the end, and we'll see you in the next one. Goodbye.